Yo, what it do, guys? Welcome back to my YouTube channel. Glad to have you guys here with me, man. Really, I'm really happy to have you guys here with me. Yeah, with your first time to the channel, please do make sure to hit that like. Just subscribe. Just asking. Subscribe if you haven't subscribed, and turn on the notifications for any future uploads I may have. And of course, after the video, leave a comment on what you think about the video. So today we're just gonna talk about the whole scaling down process when it comes to trading and how I personally use that into my advantage in order for me to take a trade. Okay, so for those of you guys who are watching this, you're not familiar with the whole scaling down technique is basically using the bigger picture in order to make decisions on the current situation that you're in. So, for example, you're gonna look at the bigger picture and then you're gonna view the bigger picture, but then you're gonna need this bigger picture in order to make a small decision, in order to basically take a trade. So obviously you might not understand exactly what I'm talking about, but we are gonna go into the video and break it down further so that you guys understand exactly how this actually works. It's just a bit of chicken nugget. So if you have your notepad, do make sure to take some notes. I think is really important, because it's one thing to just trade out of just one time frame, but when you can combine multiple time frames, like three different time frames, in order to make a trading decision based on your candlestick analysis and all those type of things, I think that really does add a whole lot of confluences into your trading. So without saying so much more, again, welcome to the channel. um, Feel free to leave a comment in there, hit a like. um just be live, man, just be live. But yeah, let's get to it. So you're talking about scaling down techniques. Basically, when it comes to scaling down techniques, you want to at least have you know three at least time frames. So one is usually going to be your highest time frame, which are going to you which is going to be you using that to basically see the bigger picture of where the market is, momentum is basically pointing to. And then your second time frame will usually be like your behavior time frame, which you are going to use to basically see what the candlesticks are saying, who the buyers or the sellers are getting into the market, or buyers stepping into the market. Are they exhausting? Are they slowing down at a potential key area? And then your last time frame is what you're going to use for your entry. And usually with your entry, you're going to want to use something like your candlestick signals and your patterns. That could be your engulfing patterns, it could be your break and retest patterns, just because it's small time frames that basically occur over small periods. So for example, you'll be looking at the daily chart, but then that's the bigger picture, of course, where you're going to be looking at the momentum of the overall trend. And then you'll have like a 4 hourly chart, which you're going to use for behavior to see at the key area that you've identified on your daily chart, to see on your 4 hourly chart whether the market is starting to stall at a specific key area, giving you indications of potential bulls or buys stepping into the market or slowing down. And then of course using maybe something like a 1 hourly chart or 15-minute chart, already depending on you, to make a final decision of how you're going to take the trade based on your patterns. Okay, so I'm going to make a quick illustration using like actual just illustration itself. And so hopefully you're following through. And again, if you are taking notes, I think that's very beneficial. So let's say for instance you've got a key area that you've identified. Okay, and this is the key area you currently are looking at, and for some reason this key area represents a potential resistance. Okay, on your daily chart, for example. So let's just say, using your bigger time frame, for argument purposes, your biggest time frame is going to be the daily chart. Okay, so your daily chart, you've identified this area to be potential resistance, and the market is kind of trending into this area now. Okay, so it's creating higher highs and higher lows into this area, and you have identified this to be a potential area of resistance. Okay, now if you have identified this to be potential resistance, and at this level for some reason, based on your technical reasons, you feel like the market should sell off at this resistance, what you want to then do is mark out your key level on your higher time frame, which is basically this, what I'm doing right here. Okay, so that when the market does come back in here, you have got a signal. You can actually set an alarm. If you've got trading view, you can actually set an alarm that if the market does come back into this level over here, I should alarm you that, hey, look, we are in a level that you've marked out in the daily time frame. And then this is now the structure you've identified. the structure being this level over here. Okay, that is your structure. So you've identified your structure in a bigger time frame. Now you will use your 4 hourly chart to identify behavior. Okay, what is behavior? Behavior is basically the way in which the candlesticks move into the resistance. Okay, so you've got your resistance level you've drawn out, and then your behavior time frame being the smaller time frame compared to the bigger picture time frame, in this case being the daily chart where you got your structure from. You'll use your 4 hourly chart to identify behavior of how the market behaves when it does come into a potential resistance or potential support. And I hope that makes sense. Okay, so that's what you're gonna use your small time frame, 4 hourly chart, for example, for. So you're gonna scale down to your 4 hourly chart, and what you're gonna want to then do is just basically look at how the market behaves when it does come into this area over here. Okay, so remember, this is your key level that you've gotten in the daily chart. The market does come into here. What you want to see is maybe, for example, you are looking to see sells from this level for some reason. You want to see small candles starting to build. Okay, small doji candles starting to form. You know, perhaps rejection candles. Um, okay, I can't actually get it so right now, but let me just see if I can extend that. Okay, so you want to maybe start seeing things like. Mm, Okay, I'm trying to get this straight. Okay, there we go. Maybe start seeing some rejection candles. That could be a doji candlesticks, or could be your engulfing bodies. So, for example, you get a small candlestick followed by a big, massive candlestick over here. Okay, you get like bearish engulfing candles. Those are basically your behavior time frame that you're gonna use to identify potential signal that bears are starting to step into the market or starting to come back into the market at the potential key area that you've identified in the bigger time frame. Okay, so that's the trip. You have to identify your key level, and then you use your smaller time frame, being something like a 4 hour or intermediate or the middle time frame, to identify behavior. Okay, behavior being like your candlestick rejections, how bears are stepping into the market or how bulls are stepping into the market, or bulls still strong, all those type of things. You're gonna use your middle time frame to identify that. Then you're gonna use, once you've gotten a signal, okay, your signal on the middle time frame being this here, for example, confirming that this area is indeed a potential strong um a potential strong resistance. Then you're gonna use your maybe your 15-minute chart time frame to then start looking for patterns. What does that mean? You're starting to want to see the bears stepping into the market in small time frames, and you want to see that they're starting to trend towards the downside. Okay, so you want to see them starting to create something called lower lows and lower highs on your smaller time frame, going towards the downside. Okay, so that is exactly what you want to see. You want to see them starting to create lower lows and lower highs on a small time frame. It might not look like this right now. It will look something more towards this here. Okay, because a smaller time frame, remember, this is from a bigger picture. This is what you got here as a behavior from your middle time frame, and then with your entry time frame, you want to see small new trends starting to form within this bigger picture to give you signal. It could even do that, to give you signals that, hey, we're about to start rallying towards the downside, okay, to wherever your target is. So these small micro trends will start forming into the small entry time frame that you have, and this is basically what you want to use to your advantage in order to take the trade. Okay, so we're going to go into the live markets and make an example. Hopefully we can come up with an example for you guys to see exactly what I'm talking about over here. Okay, so let's just say, for example, we've got a key level over here. Okay, this is a potential resistance. Why? Because we're currently sitting in a range. So I'm going to mark this out as well. We've got a range over here. Okay, you can see the market has been moving in this block for quite some time and hasn't been able to escape this block for quite some time. So we are in a range. Okay, so let's just say that you've marked out this to be your resistance because the markets are failing to break above, and you then mark to support at the bottom because the market has failed to break the bottom. So what's the next step? Now the market eventually does happen to break above this level, which is this, what you can see over here. The market breaks the level, And then of course this is your potential support resistance that you have thrown out that turns into a support. Okay, once you have this break, let's just say come into the market and it looks like this. That's what you're looking at right here. Okay, what you want to then do is, because you've got your support now, your resistance that was now, once the resistance has become a support, once it's broken, you want to see the market come back into this level. You have to be patient and wait for the market to come into this level. Remember, this resistance you've drawn out, you've gotten from your bigger time frame. You do not get your structure levels on small time frames and then work your way up. No, you get the bigger picture first and then you scale towards the downside. So in this instance, if your market is looking something like this, what is your current structure? Your biggest time frame structure will be this one over here. Okay, so this will be your structure that you've drawn out. Why? Because that is an area where the market has been failing to break in the past. So there's a high chance, based on theory, not the holy grail, just based on theory, there's a higher chance that the market is gonna come back to an area that has broken, that has failed to break before. Okay, just theory. Okay, that's basically what we're doing, is just theory. So you wait for the market to come back into this level patiently, and once it does come back into this level, okay, what you then want to do is scale down to your time frame that you're going to use for behavior. That is your second time frame, a behavior time frame. Okay, so you're going to scale down. As you can see, we've come into this level. You're then going to scale down to see more details. This is the reason why we scale down, as to see more details of how the market behaves when it does come back into that key level. I hope that makes sense. That means that you're gonna have to practice your eyes to identify candlestick patterns and all those type of things, because you're not just gonna pick it up out of the blue. Your eyes have to literally, you have to practice to identify candlestick patterns, momentum candles, resistance, and all those type of things. But nonetheless, let's just go to smaller time frame, and we're gonna see how the market behaves in this area. That's all we use this time frame for, is to literally identify the behavior of candlesticks into this area. Now, once you go to our behavior time frame, remember, this is the key level that we've got. Um, this key level over here we got from our big time frame. Now this is our middle time frame. Okay, this is now our middle time frame, and this is our, remember, this is our key level from the bigger time frame. This is our middle time frame, and all we're doing over here is looking for behaviors at this level. So we patiently wait for the market to come at this level, and once it does come in there, we want to see small candlesticks starting to form to give us signal that the sellers are starting to diminish, they're starting to slow down, and potentially bulls could be stepping in. That might mean that you are looking for rejection candles, which means small bodies with big wicks, and then that's what you're looking for to give you signals that, hey, we are starting to reject this area and potentially buyers can be stepping in. Plus, added to the confluence that this area that you've drawn out is based on your bigger time frame, and then you're using a smaller time frame, a middle time frame, to identify this rejection candles is going to be a better confluence. Okay, so once you see this first rejection, second rejection, okay, look there, smaller body, bigger wicks, those wicks represent rejection. So once you start seeing those rejection forming on there, it's a good signal that, yo, this area that you've identified on your bigger time frame is indeed holding. Okay, that's what that signals. It means that it is indeed holding, because you're starting to see smaller bodies, bigger weak rejections as an indication that, yo, you can actually start to step into this market. Now, once you do this, you are more than welcome to actually take a buy on your base just on the candlestick and um your candlesticks and your bigger time frame structure. But then you can also make use of your smaller time frame to start identifying patterns, tradable patterns. So once you get to rejection, what you then want to do is mark the top of that rejection level, which is what I would personally do. Mark the top of this rejection candle. The reason why you want to do this is because if you do scale down to your smaller time frame, you will see then that this area here is actually a consolidation. Okay, so you're gonna see now, and this is why once you scale down to your smaller time frame, you only use your smaller time frame for patterns, nothing else but patterns. Okay, so once again, guys, remember, this level here, this we've drawn, is from the bigger picture. Okay, your middle time frame you are using for behavior, which we already got, which is the rejection candles. And then your middle time frame, you're gonna use that for patterns. What is patterns? Remember, you've drawn this level now from a middle time frame. Now you see that the market is starting to stall around this level, okay? Meaning it's not going anywhere, it's just ranging. And as you know, if you've been trading for quite some time, in the ranging market, what you want to do is don't trade it. You want to see the market break out of a range, get the retest, and then only you take the buy. So in this instances, this is the only time you're going to use your smaller time frame. You're only going to use your smallest of time frames to take patterns. So you're looking for your break and retest, immediate breakouts, um, whatever the case may be that you are trading. For me personally, I'm mainly a break and retest trader. Okay, or I might take a complete immediate breakout. Really, all depends on the times and all those and the hours and the momentum and all those type of things that's happening in the markets and what time of the day it is, all those type of things. But mainly, I'm a break and retest trader. So in this instance, all you're doing on the smallest time frame again is identifying patterns in the range. What you're looking for is you don't take any trades in the range because there's a whole lot of stuff happening in the middle of a range. We don't know who's in charge. Is it buyers or is it sellers? None of us know. So we stay out of the market and all we wait for is for break and retest. Okay. And this is exactly what happens here. We have a break, we have a retest, and then once you do get the retest, again, same thing applies. You're waiting again for the market to come into this area and then give you rejection candles, which is what you're having here, engulfing bodies, and you can look to take a trade. In this instance, you could definitely execute this. Okay. Using scaling down techniques alone and candlestick patterns to take this trade. Okay, so as you can see here, if you went for your target, let's say your stop loss is below structure and you've gone for your target, let's just say about 1 to 3 or 1 to 2, in this case for a 12, that's enough. Let's say you went for 4 pip stop loss and then your target is about 12 to make, so you're basically risking 1 to make about 3. You can see here you would have gotten take profit over here. Okay, and guys, this is just based on simple understanding of scaling down techniques. It's not rocket science. Either is it the holy grail. You are gonna have winning trades, you are gonna have losing trades. I'm just making use of past data to drive down the home. So don't be out there at the back of your screen going on like, yeah, but this brother is using like, previous old stuff that he basically have gone. Guys, it's literally theory that you can use in a live example. Okay. And speaking of live examples, let's just see what we can identify while we are on this video, while I'm recording this actually, if there is anything I can identify. So don't just sit there and be like, oh, Sacre, you just basically making up things, or you've studied the past data, now you're trying to like, guys, it's literally what happens. And if you keep taking these examples over series of trades, you are going to be profitable because it's proven. Not just because, don't just take my word for it, but I'll definitely recommend that you do your own back testing, meaning put some more hours into it, check it out for yourself, see exactly what's happening, and then because it's one thing for me to just tell you that, but it's another for you to actually go home, do your homework on it, and see how it all plays out. Okay, so I hope you guys do get the point or trying to make is that you can get more confluence when you make use of multiple time frames. So you're not just making use of one time frame, taking trades in that one time frame, because you kind of end up getting in late, or you're gonna be ending up getting into the trade based on impulses. Okay, be patient, identify your key levels, have a middle time frame that you would like to use to identify behaviors of the time frame, basically confirming that the bigger time frame is holding up, the structure is holding up, whatever the case may be, and then scaling down to your smallest time frame that you prefer using for your indies to then look for patterns, strictly patterns. Okay, that's basically it. I hope you guys learned something from this video. And once again, if it's your first time to the channel, please do make sure to leave that subscribe button, comment in the comment section, and smash that like button. I really appreciate the support. It also just helps with a lot of the algorithm and things like that. So yeah, hopefully you guys learned something new from this video, and until next time, I will see you guys on the flip.